Hello everyone, I'm Rohit Agarwal and I look at equities at Kotak Life Insurance. Few investor queries that we have had are: why have the markets corrected? Is it due to valuation, interest rates, inflation, or is it geopolitics? Our answer to that is it's a mixture of all of these. Well, we also believe that but for geopolitics, a lot of these factors might have been factored into markets. That means that the markets would have become a buy on dips market. What has geopolitics changed? For that, we need to understand what was happening before geopolitics came in. What was happening was interest rates were at record lows. There was abundance of liquidity that was chasing asset classes across the world. Inflation had started to go up, mostly in commodities and goods. Well, that meant that at some point, the central bankers across the world had to withdraw some liquidity or raise interest rates. That was already happening. The markets across the world can digest some withdrawal of liquidity and hardening of interest rates as long as that is because of the economy is doing well and demand being very solid. Enter the geopolitics. Now, what has that done? What geopolitics has done is that it has completely choked some of the supply lines which were already getting choked. Now, these supply lines, which have been choked due to geopolitics, are not going to come back on stream for the next 6 to 24 months, give or take. These are mostly to do with commodities and food grains. What that means is that there is currently a vicious circle. The vicious circle is that supply is less. A lesser supply means higher price. A higher price currently means that central bankers across the world are in a dilemma to raise rates or not. In a normal scenario, they would have raised rates. But currently they are worried that if they raise rates now, will it lead to a collapse in demand and will it lead to a recession? That puts them in a catch-22 situation. However, the good part about geopolitics is that the vicious circle can become a virtuous circle very soon. How is that possible? Hypothetically, if the geopolitics were to end soon, what we can see is that the commodity prices will come down, the inflation expectations will start to come down, the pressure on the central bankers to keep raising interest rates will at the margin come down, and the interest rate rises will be more calibrated and can be matched with the demand and the economic scene in the world. That essentially means that the whole cycle from vicious to virtuous can turn in a matter of months. So what is our recommendation? Our recommendation is that the markets currently are not in the zone where you should just go and buy. They are in the zone where you have to carefully look at what's happening across the world on macro and geopolitics. As soon as the geopolitics is sorted, we will have better clarity and better confidence in buying in the markets. Till then, the markets in pockets will give us opportunities to buy, but at the same time, we have to be cognizant of the risk, the biggest lurking risk, which is that if prices remain high for longer, killing those prices by killing demand could mean recession. And that's the most difficult part for central bankers as well as governments across the world. Some governments will react and try to protect it, like what we saw in India just last week, where the government has taken steps to cool down inflation. Although inflation will cool down on a headline basis, but it has impact on the fiscal situation. So as you see, the situation is not easy. At the same time, the markets have corrected and valuations have started to get into the zone where you can start to nibble. At any declines of more than 5 to 10%, the markets will start to get into a zone where you could say that long-term averages is something that I can take into account and start buying. However, the biggest variable will remain the macro, which will be driven by geopolitics more than anything else. If that were to get solved, we would recommend buying aggressively into the dips. That's how we think the markets will play out. Thank you.